You know what's fascinating? Every time gold hits new highs, the same chorus starts singing the same tired song. It's a bubble, they cry. Gold doesn't produce anything, they shout. It's just shiny metal, they proclaim. And you know what? I used to think the same thing. Until I saw the data that changes everything. Picture this. It's 2011, and gold just hit $1,900 an ounce. The financial media is going absolutely crazy. CNBC has talking heads screaming about the gold bubble bursting any day now. Bloomberg is running segments about how gold is the tulip mania of our generation. Even Warren Buffett is out there saying gold just sits there and does nothing. Fast forward to today. Gold is pushing toward $2,100, $2,200, and beyond. Those same voices are getting louder. See, we told you it was a bubble. But here's what they're not telling you. Here's the data that will absolutely shock you about what's really happening in the gold market right now. Let me start with something that will blow your mind. Do you know who the biggest buyers of gold have been over the past 3 years? It's not retail investors panic buying coins. It's not even hedge funds making speculative bets. It's central banks. The very institutions that print the money you and I use every single day. In 2022, central banks bought 1,136 tons of gold. That's the highest level since 1967. But wait, it gets better. In 2023, they bought another 1,037 tons. We're talking about nearly 2,200 tons of gold purchased by central banks in just 2 years. To put that in perspective, that's more gold than most countries have in their entire reserves. But here's where it gets really interesting. These aren't just any central banks. We're talking about the People's Bank of China, which has been buying gold every single month for over a year straight. The Reserve Bank of India, which just added another 27 tons to their reserves. The Central Bank of Turkey, which has been one of the most aggressive buyers on the planet. Now, I want you to think about this for a second. These are the smartest financial minds in the world. These are the people who understand monetary policy better than anyone. These are the institutions that literally create money out of thin air. And they're trading their own currencies for gold at a pace we haven't seen in over half a century. Does that sound like bubble behavior to you? Let me tell you a story that perfectly illustrates what's really happening here. Back in 1971, President Nixon made what he called a temporary decision to close the gold window. For the first time in American history, the dollar would no longer be backed by gold. It was supposed to be a short-term fix to help with some economic pressures. That temporary decision is now in its 53rd year. But here's what most people don't realize about that moment. When Nixon closed the gold window, gold was trading at $35 an ounce. The government had been artificially suppressing the price for decades through the Bretton Woods system. The moment that artificial ceiling was removed, gold didn't just rise, it exploded. By 1980, gold had reached $850 an ounce. That's a 2,400% increase in less than a decade. But here's the kicker. That wasn't a bubble either. That was gold finding its true market value after decades of artificial suppression. And I believe we're seeing the exact same thing happening right now, just on a much larger scale. You see, for the past 15 years, we've been living in the most extraordinary monetary experiment in human history. Since the 2008 financial crisis, central banks around the world have printed more money than in all of previous human history combined. The Federal Reserve's balance sheet went from $800 billion to over $9 trillion. The European Central Bank, the Bank of Japan, the Bank of England, they've all done the same thing. We've had zero interest rates, negative interest rates, quantitative easing, yield curve control. Policies that would have been considered absolutely insane just 20 years ago are now standard operating procedure. And what's been the result? Asset prices have gone through the roof. Stocks, bonds, real estate. Everything has been inflated by this massive monetary expansion. Everything except gold, which has been remarkably restrained considering the scale of money printing we've seen. But that's starting to change, and the smart money knows it. Let me share with you some data that most people never see. Did you know that the COMEX, which is the primary exchange where gold futures are traded, has a paper-to-physical ratio of over 100 to 1? That means for every ounce of physical gold that actually exists in their vaults, there are over 100 paper claims on that same ounce. Think about that for a second. If even 2% of the people holding paper gold decided they wanted physical delivery, the entire system would collapse overnight. And guess what's been happening? Physical demand has been absolutely exploding. The US Mint sold over 24 million silver eagles in 2023, one of the highest years on record. Gold coin sales are through the roof. Precious metals dealers are reporting wait times of weeks or even months for certain products. But here's where it gets really interesting. While retail demand has been strong, the real action is happening in the wholesale market. Large institutions, family offices, sovereign wealth funds, they're all quietly accumulating physical gold at levels we've never seen before. I was talking to a dealer in London just last week, and he told me something that gave me chills. He said the premium for physical gold over the paper price has been steadily increasing. In some cases, you're paying $100 or more over spot price just to get your hands on actual metal. That's not bubble behavior. That's shortage behavior. And speaking of shortages, let me tell you about something that's happening in the mining industry that almost nobody is talking about. Gold production peaked in 2018 at about 3,300 tons per year. Since then, it's been declining. The easy gold has already been mined. The ore grades are getting lower. The costs are getting higher. Meanwhile, demand keeps growing. Industrial demand for gold is at all-time highs. Electronics, medical devices, aerospace. Gold is essential for modern technology. And as the world becomes more digital, that industrial demand is only going to increase. But here's the real kicker. Do you know what the total above-ground supply of gold is? All the gold that's ever been mined in human history. It's about 200,000 tons. That sounds like a lot until you realize that's worth about $14 trillion at today's prices. Compare that to the total value of global stocks, which is over $100 trillion. Or global bonds, which is over $130 trillion. Or global real estate, which is estimated at over $300 trillion. Gold represents less than 3% of global financial assets. If gold were to return to just its historical average allocation of 5 to 10% of global wealth, we're talking about a price that would make today's levels look like pocket change. Now, let me address the elephant in the room. The critics love to point out that gold doesn't pay dividends or interest. They say it just sits there and doesn't produce anything. And you know what? They're absolutely right. Gold doesn't produce anything. But that's exactly the point. Gold doesn't have counterparty risk. It can't be printed into existence. It can't be hacked or deleted. It can't go bankrupt or default on its obligations. In a world where every other asset depends on the continued functioning of increasingly fragile financial systems, gold is the ultimate insurance policy. And right now, that insurance is looking more valuable every single day. Let me tell you about what's happening in the currency markets that most people are completely missing. The dollar's dominance as the world's reserve currency is under attack like never before. China and Russia are conducting trade in their own currencies. The BRICS nations are working on their own payment systems. Saudi Arabia is accepting yuan for oil payments. This isn't some conspiracy theory. This is happening right now, in broad daylight. And every step away from dollar dominance is a step toward gold's return as the ultimate store of value. I want to share something with you that might be relevant to your situation. If you're sitting on $100,000 or more in retirement accounts, there's something you should know about gold IRAs. I've put together a comprehensive guide that explains exactly how you can get physical gold into your retirement account without triggering tax penalties. It covers everything from the IRS rules to the best custodians to work with. You can find that guide in the description below. It's completely free, and it might be worth checking out if protecting your retirement wealth is important to you. But let me get back to this bubble narrative, because there's something else the critics are missing. Every real bubble in history has been characterized by massive speculation, easy credit, and widespread public participation. Think about the dot-com bubble. Everyone and their grandmother was day trading internet stocks. The housing bubble. People with no income were getting million-dollar mortgages. Where's the speculation in gold? Where are the gold commercials during the Super Bowl? Where are the gold day trading apps? Where are the college kids maxing out credit cards to buy gold coins? The truth is, gold ownership among the general public is at historically low levels. Most people under 40 have never owned an ounce of gold in their lives. Most financial advisors recommend zero allocation to precious metals. Most pension funds and endowments have less than 1% of their assets in gold. This isn't bubble behavior. This is the exact opposite of bubble behavior.
But here's what really gets me fired up about this whole bubble narrative.
The same people calling gold a bubble are the ones who've been cheerleading the biggest bubbles in financial history. These are the same experts who told us housing prices never go down in 2007, the same ones who said tech stocks were reasonably valued in 1999, the same ones who are now telling us that a stock market trading at 30 times earnings in an environment of slowing growth and rising rates is perfectly normal. They've been wrong about every major market call for the past 25 years, but somehow we're supposed to trust their judgment on gold.
Let me share with you a story that perfectly illustrates the hypocrisy here.
In 2020, when the Fed announced unlimited quantitative easing, Tesla's stock went from $200 to over $1,200 in less than 2 years. A company that had never made a consistent profit was suddenly worth more than the entire automotive industry combined. Did anyone call that a bubble? Of course not. That was innovation and disruption. But gold, which has been money for 5,000 years, goes from $1,200 to $2,100 over 4 years of unprecedented money printing. And suddenly that's a bubble? The cognitive dissonance is absolutely stunning.
Here's what I think is really happening.
The financial establishment is terrified of gold because gold is their kryptonite. Gold is the canary in the coal mine of monetary policy. When gold rises, it's telling you that the currency is being debased. It's telling you that the purchasing power of your dollars is being eroded. It's telling you that the promises of politicians and central bankers aren't worth the paper they're printed on. And right now, gold is screaming at the top of its lungs. Let me give you some perspective on just how restrained gold's performance has been. Since 2000, the Nasdaq is up over 400%. The S&P 500 is up about 350%. Even bonds, which are supposed to be the safe, boring investment, are up over 200%. Gold? It's up about 550%. That sounds like a lot, until you realize that during that same period, the money supply increased by over 800%. Gold hasn't even kept up with money printing, let alone created a bubble.
But here's where it gets really interesting.
All of those other assets, stocks, bonds, real estate, they've been supported by the lowest interest rates in human history. What happens when rates go back to normal levels? What happens when the Fed can't print money anymore without causing runaway inflation? We got a taste of that in 2022. Stocks crashed, bonds crashed, real estate started rolling over. But gold? Gold held its ground, and then some. And that's just the beginning. Let me tell you about a conversation I had with a portfolio manager who runs money for some of the wealthiest families in the world. He told me something that stuck with me. He said, "We don't buy gold because we think it's going to make us rich. We buy gold because we think everything else is going to make us poor." That's the mindset of real wealth. They understand that gold isn't an investment. It's insurance. It's protection against the inevitable consequences of fiscal and monetary irresponsibility.
And those consequences are starting to show up everywhere you look.
Inflation, which we were told was transitory, is proving to be anything but. Even with all the statistical manipulation and hedonic adjustments, official inflation is still running well above the Fed's target. But real inflation, the kind you experience when you go to the grocery store or fill up your gas tank, is much higher than the official numbers suggest. And it's not just in the United States. Inflation is a global phenomenon right now. The European Central Bank is dealing with inflation levels they haven't seen in decades. The Bank of Japan, which has been fighting deflation for 30 years, is suddenly worried about prices rising too fast. Even China, which has been the world's deflationary force for the past 2 decades, is seeing price pressures building.
This is what happens when you print trillions of dollars and inject them into the global financial system.
There's no free lunch in economics. The bill always comes due eventually, and when it does, gold will be there. But let me tell you about something even more important than inflation, something that could make the inflation of the 1970s look like a minor inconvenience. I'm talking about the potential collapse of the dollar's status as the world's reserve currency. For the past 80 years, the dollar has been the foundation of the global financial system. Every major commodity is priced in dollars. Every central bank holds dollars as reserves. Every international transaction ultimately clears through the dollar-based banking system. But that system is under attack like never before. China, which is now the world's second largest economy, is actively working to reduce its dependence on the dollar. Russia, after being cut off from the SWIFT system, has accelerated its de-dollarization efforts. Even traditional U.S. allies like Saudi Arabia are starting to diversify away from dollar-denominated assets. What happens if the dollar loses its reserve currency status? What happens if countries start demanding payment in gold instead of dollars? What happens if the petrodollar system, which has been the foundation of American economic dominance for 50 years, finally breaks down? I'll tell you what happens. Gold goes to levels that will make today's prices look like a rounding error.
And the signs are everywhere, if you know where to look.
Central banks aren't just buying gold, they're repatriating gold. Germany brought home 300 tons of gold from New York and Paris. The Netherlands repatriated 122 tons. Austria brought home 110 tons. Why would these countries go through the expense and logistical nightmare of moving tons of gold unless they were worried about the stability of the current system? But here's what really keeps me up at night: the derivatives market. Did you know that the total notional value of derivatives contracts is over $600 trillion? That's more than 7 times global GDP. These are complex financial instruments that are interconnected in ways that nobody fully understands. What happens when this house of cards starts to collapse? What happens when counterparties start defaulting? What happens when the rehypothecation chains that hold the system together start breaking down? In that scenario, physical gold isn't just an investment. It's a lifeline. Let me share with you one more story that perfectly illustrates why gold isn't a bubble. Back in 2008, when Lehman Brothers collapsed and the financial system was on the brink of total meltdown, what did central banks around the world do? They didn't print more stocks. They didn't create more bonds. They didn't manufacture more real estate. They went back to gold. The Federal Reserve, which had been selling gold for decades, suddenly stopped. The European Central Bank, which had been part of the central bank gold agreement to limit gold sales, quietly let that agreement expire. Central banks around the world went from being net sellers of gold to net buyers almost overnight.
Why? Because when the chips are down, when the system is under stress, when confidence starts to crack, there's only one asset that has maintained its value for thousands of years. There's only one asset that doesn't depend on the promises of governments or the solvency of financial institutions. And that asset is gold. Now, I want to be clear about something. I'm not saying gold is going to go straight up forever. Markets don't work that way. There will be corrections. There will be volatility. There will be periods where gold underperforms other assets. But the long-term trend is clear. As long as governments continue to spend more than they take in, as long as central banks continue to print money to finance that spending, as long as the global financial system becomes more complex and more fragile, gold will continue to rise. And anyone calling it a bubble is either ignorant of the underlying fundamentals or has a vested interest in keeping you away from the one asset that could protect your wealth from what's coming. The data doesn't lie. Central banks are buying. Physical demand is exploding. Supply is constrained. The monetary system is under unprecedented stress. Geopolitical tensions are rising. Currency debasement is accelerating. These aren't bubble conditions. These are the exact conditions that have driven gold higher throughout history. So the next time someone tells you gold is a bubble, ask them this. If gold is a bubble, what does that make a stock market trading at 30 times earnings? What does that make a bond market with negative real yields? What does that make a real estate market where the average home costs 8 times the median income? If gold is a bubble, then everything else is a supernova.
The truth is, we're living through the greatest monetary experiment in human history. We're witnessing the slow-motion collapse of a financial system built on debt, leverage, and the false promise that you can create wealth by printing money. Gold isn't the bubble. Gold is the pin. And when this bubble finally bursts, when the artificial supports are removed, when reality finally reasserts itself, gold will be there. Just like it has been for the past 5,000 years. Just like it will be for the next 5,000 years. The only question is, will you be ready?